This is the 2020 IRS Data Book. I'm not entirely sure what prompted me to do this, but it has been a little while since I've posted one of these, and I do like going through this every year. This talks about every statistic that you can think of concerning the U.S. Tax Collection Agency and what they do and how they do it. And I think it's really interesting. So I'm going to talk about just a few things I thought were kind of cool, and then we'll get into the potatoes of this thing. I hope I have these queued up in order. Let's see. Yeah. So first things first, something that has always astounded me when I travel to other countries is that Americans are super afraid of the IRS, and that's not the case in a lot of places. I think there is something good to be said about a strong centralized government, which we do have. It does aid in regulation and stabilization of an economy. It does foment fear and I want to say completion. That's not the right word though. It makes people, comply. And so anyway, so this is really interesting. I thought when asked, right, how does someone feel about the IRS? 30% were very happy with the IRS. 50%, of those surveyed were somewhat happy with the IRS. That being said, we're talking about 80%. 80% of those surveyed um, actually like the IRS and what they're doing. And that goes a long way because we are all familiar with the numerous amount of memes and all this hoopla around taxes and the IRS, and it's always a joke in our American comedies where no one likes the IRS. Everyone hates the IRS. The IRS is taking my money. It's theft, blah, blah, blah. But in reality, most Americans not only comply uh, with the IRS, but they actually enjoy it. I think if asked, they prefer the IRS. There were some conversations concerning doing away with the IRS back when defund the police was a thing. I thought that was interesting because it was something that wasn't seriously considered, but it was at least a conversation. And the question then becomes, well, if not the IRS, then who? I mean, taxes have to be collected. When you look at other countries, um, and I'm saying other countries, I can't put a number on it, but in a lot of countries, the majority of the population are self-employed, and so it's very hard to tax hand-to-hand cash transactions, especially when you're talking about, something less than a first world country that maybe doesn't have a lot of credit cards and it is a lot of cash transactions. There are some third world countries that don't really accept credit cards much at all. And then how does the government tax? And the question becomes, if the government can't tax, how can the government be strong? And if the government isn't strong, how can the government provide for its people? So a lot of things I think to be said about that. But at the end of the day, this is where we are. 80%. All right. Let's move on. Yeah, so taxes have actually come down. Now, keep in mind the data book is very lagging. Okay, so we're talking about as of year 2020. The 2021 tax book won't be due out until possibly July or August of this year, sometimes later. But anyway, taxes are actually coming down. We're actually paying just a little bit less tax, but you can see by this graph overall, over the last 10 years, we've paid increasingly more tax, except for businesses. And so we'll get into that here in just a moment. The other thing, and this is across the board, I'm sure you've dealt with this. If you haven't, I'm sure you will. The IRS got hacked. I forget how long ago now because it's been so long, but they got hacked maybe 2014, 2015 at the very latest. I think it was earlier than 15, but 2015 at the very latest, they were hacked, and a lot of Social Security numbers were stolen. And so ever since then, the IRS has increased their identity protection program tenfold. Now, of course, this graph, I don't know if it shows a tenfold increase. I doubt it. Well, no, it does actually. It's a 100% increase, actually, more than 100% increase. So, yeah, if you haven't been touched by this, then I'm sure you will at some point, or someone you know has. And so it is going to be increasingly important that you do keep up with that identity protection pin, because it can make e-filing a real pain. And I don't think that's going to change anytime soon. Okay, so this just goes back to the amount of tax that's being collected, and I thought this was an interesting chart here. This goes from 1960 through 2020, and my memory is now jogging. What prompted this, what inspired me, was a movie that I saw last night. I forget the name of it right now. I'll look it up later, but it was the guy who was the labor director under Bill Clinton is who was the main guy in this particular documentary. There was another guy who wrote a book called "I Am the 1%," and in this they talked about wealth inequality and kind of where we are, where we came from, and how we got here. And so I thought it was really interesting, and really kind of got me thinking about some things. And so that's why I'm here today. So, what I'm looking at is just the difference between business income taxes, right, and then individual income tax. And as you can see, in 1960, half, right? So individuals paid what businesses did, and now 1960s tax returns look a bit different than current today's returns. But I do think what's happening here is that businesses will file taxes for the business, but then they also have personal income as well a lot of times. And so that's the reason why individual income tax is always going to be higher than business, because like I said, just only pay a business tax and also a personal tax. But as you can see, and as I'm sure you know, in many cases, that tax is a lot less than what your typical, 9 to 5 wage earner is going to pay. As far as so, let's just go down the list, and everything is about how we get here in 1968. Okay, 1968 was at Nixon, LBJ, those guys, and they started to lower the corporate income tax. That's when this stuff started. Okay, so now we're about 3 times, right? Okay. So three times, um, 3 times roughly. We're getting a bit higher. 3 times, and then we get down here to 1979, 1980, and we're up to 4 times. Individual paying 4 times the amount of tax in 1980. And the number basically just keeps increasing. It goes up to 5 times very quickly, very quickly. 1982, 1983, this is Reaganomics. This is the trickle down theory of economy. And then we see in 1986, it gets up to 5 times more. And that trend pretty much stays the same. It does get a bit like 495. Those are Clinton errors. But it stays pretty much at about 5 times throughout. What I think is really interesting is, you know, I get into these political conversations, most of us do. And my response for the last 20 years um, has been that politics don't really affect me, you know, and I get some weird looks and I get some pissed off people sometimes when I say that, but my mentality is I am in a system and my job, my goal is to work within that system, outside the system, whatever I have to do um, to better my life, my family. So for me, it doesn't matter what rule you give me. My job is to figure out a way to make that rule work for me. And so, you know, when you look at this chart, I mean, we've gone through I don't know how many presidents between 1980 and 2020. And some have been Democrats, some have been Republicans, and the number hasn't changed. It's still 5 times. Um, we do see here that in what's this 17, 18, 19, that's Trump who lowered the corporate tax to was it 20%, and that number has increased. I can't even do the math on that. I think that's 6 times, right? 6 or 7. Let me see, 25 times 7. Yeah, 7 times. That's where we're at right now. And so the question becomes: Is that something that we can continue increasing? You know, how far does it go before we have a whiplash, a backlash? We did see that in the early 2000s with the Occupy Wall Street, which did make some changes, but not a whole lot. Again, looking at this graph, it didn't make any difference whatsoever. Um, you know, a lot of people like to talk about possible 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 situations in which anarchy can take place, for lack of a better word. And those are always interesting discussions, at least for me anyway, exercises if nothing else. And I like to consider myself someone who wants to be prepared for any. And the question is, again, you know, how far can this go um, before we do some sort of backlash, whiplash? You know, right now, in the past couple years anyway, there's a lot of talk about fascism, and you know, based on these numbers, I mean, that's kind of what fascism is, right? When you have such a heavy leaning in preference to one group of people over the populace, at some point the populace is going to get pissed off, and it makes sense that if the government are the ones that are making these rules and they are favoring, let's say, the business elite at this point, right? Because that's how it's discussed in conversation. It's more of us than them, and so at some point it becomes the populace against not only the corporate entities, but also the government who's on the side of those entities. America does not have a long history of uprisings, overthrows, and that sort of thing. We have seen that in other places around the world, not here in America. And again, it goes back to having the strong centralized government. When you have a populace who is complicit in obeying rules and regulations set forth by the government, it's very hard for that populace to then decide, okay, we're no longer obeying and we're actually going to overthrow you. Very difficult. Can it happen? Yes, it can. Has it happened? No, it has not. It has not happened ever. You know, the Civil War was the only time in American history that we've ever seen anyone disobey the United States government, and that was very, very early in our time as a country. So it's hard to even consider that a real overthrow. I mean, it was barely put together. You know. So anyway, that's that. Kind of just where we are. I don't see that changing anytime soon. If it does change, I think it's going to be either gradual or it's going to be an abrupt change. All right, so getting into the meat and potatoes part of this, what I really go to this data book for is to look at how the IRS is administering tax returns. And what I mean by that is how are they treating tax returns? And so for me in my business, but also as an American taxpayer, my concern is audit because again, we are deathly afraid of the IRS. They will come to your house, they will put you in jail, they will take your possessions, right? And if not that, it's a hassle. It's a hassle. It's a hassle. You know, in my career, I tell people all the time that, you know, a large part of what I do is calming people down because when they come to me, it's because they received a letter or some threatening statement from the IRS saying that they're going to do this and they're going to do that, and I have to just calm them and say, listen, it's going to be okay. It's nothing to be afraid of. And like I said, it's such a stark contrast to how someone in another country views their taxing authority. I mean, it is amazing. And you don't really understand the difference until you get to those places and actually get in with the citizenry there and talk to them about their tax situation and their tax structure. They aren't really afraid of their taxing authority. You know, even when I look at the buildings where their taxing authorities have, you know, where they set up shop, right, like their their offices or whatever. They are paltry. They're tiny in comparison to what we have here in the States. Granted, haven't been over to Europe. I imagine that their taxing authority is going to be just as big, if not bigger. But other than that, yeah, tiny and like people just don't even pay attention to it. Really, it's really interesting. But importantly, again, what we're getting to is that the number of examinations have come down considerably. Considerably, considerably, considerably. We're not. So again, this is a tool, right? These are numbers, these are statistics that you can point to say, listen, you don't have to worry so much, right? The chances of you being audited are decreasing more and more and more and more. You know, I had a lot of conversations with a young lady who's become a really good friend of mine in the industry. And we discuss these things every year. Last year, the big thing was the SBA and the PPP loans and stimulus and all this kind of stuff. And the thing that we always talked about, and others too in the industry, is how is this going to be administered? They were so quick in passing these acts and passing these bills and passing these laws without thinking about how is the IRS going to administer this. What they did was they just passed the bill. They just passed it. They said, here's the rules. This is what we're going to do. And then they just gave it to the IRS and said, you guys figure out how to administer this. And not only did they say, okay, now you guys administer it, but they didn't even give them time to come up with administration. Like, I'm sure I talked about this in some of my other videos. I mean, there was absolutely no IRS procedure manuals written about this stuff. There was no publications written about this stuff. There was nowhere to turn to get IRS guidance on how any of this stuff was going to be administered. You know, I just had that conversation a few nights ago, right? So someone receives a PPP loan, and so the question becomes, well, they're a Schedule C filer. How do they show that they use the PPP loan as payroll, as salary? Well, if you're a Schedule C individual filer, technically your salary is your net profit. But then too, if you W-2 yourself as a 1099, which most don't, I mean, as a Schedule C, which most don't, that salary then, that PPP loan will be an expense. You know, it's really interesting. I mean, what do? Do you 1099 yourself? Do you file two Schedule Cs, one with business expenses, the other with no expenses, just showing a 1099 to yourself? And then the question becomes, well, who cares what you do? Because who's going to audit this? Does the SBA have access to your tax returns? No, they don't. They can't just call up the IRS and say, "Hey, give me a copy of his tax return," unless you give them permission to. When the SBA asks persons to apply for these loans, did they ask for a 4506T with your 2021 tax return being a subject of focus? I think so. So if you gave them permission to pull your transcript, then they can pull it. But again, is the SBA going to audit? I mean, do we have any history of the SBA auditing anything? Does the SBA have any sort of guidance as to how they're going to audit and where and when? So again, a lot less for you to be concerned about. The other thing too is that, as you can see in blue, you have correspondence, in green you have field. Correspondence means it's just a letter. So a lot of these letters are just letters. They're automated things that go out that don't mean anything. A lot of times when these letters go out, there's no one at the IRS that even knows that the letter has gone out. It's really ridiculous. I've personally called the IRS and said, "Hey, my client received a letter." They said, "Well, we don't know where it came from or what it is." And I'm just like, okay. And then you can give them the actual letter number, which corresponds with which type of letter it is. And they say, "Oh yeah, well, we know what type of letter that it is, but we don't know why they got it necessarily. We'll have to figure that out." Meaning, I have to figure that out. So what you see there in green is a paltry number. We're talking about less than 0.2 million returns being audited, and I imagine that number is going to continually decrease. All right, so now to the meat and potatoes, the thing that I come to first when I'm looking at the data book is the actual number of returns that have been audited, the type of returns being audited, and how many are showing that additional monies were asked from the taxpayer. Okay, and this is very interesting. I want everyone to understand this. No total positive income. Total returns being audited 1.76 million, and I might be wrong about that because these numbers might be in thousands. But I don't see any footnote that says they are, so let's just assume this number is exact as it is. So 1.76 million returns without positive income, meaning that you filed a return that has a loss on it. And we're talking about individual returns. Now, there are net operating losses, which are great because it means that every year you're filing a negative return, but that also increases your chances of being audited. So a lot of times I have counseled with clients, and I've advised, you know what, you might want to show $1 of income. Right? Because remember, this stuff is not being looked at by people. This is being looked at by a computer. There's no way people can go through 1.7 million returns. Ain't happening. Okay. And in total, we're talking about 12 million, almost 13 million returns. And these are just the returns that's being audited. These aren't the total returns for the US, right? So, we're talking about all the computer is looking at is just a number. That's it. If your return is a zero income or negative income, automatic chance of you being audited goes up. So sometimes just reporting $1 is better than reporting nothing at all in certain situations, right? Okay. And then out of that, again, we see really substantial chunk of that are field examinations. I'm not going to pull out the calculator here. I think we can kind of just kind of look at generally what this is compared to income of $1 to 25,000. The number of field examinations, meaning actually going into the IRS office, is way, 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 way less than if you file, like I said, no positive income at all. All right, and then just going down the list, you can see here, you know, when you get to, and again, I'm not going to pull out a calculator here. I kind of explain what's going on with that here in a moment. But when we look at, again, total returns being um, being examined based on income, it goes down with the more income you have until you get to the really high numbers. And that usually comes about 10 million. Sometimes you'll see that in the $5 million range. Okay. And then there's a bit of variance, as you can see, between the 50 and 75, and then when you get up to like 100. Okay. Now, keep in mind, we're not looking at percentages here, so it's going to be really hard to kind of see what that is. We'll talk about that here in a second. All right. So corporation returns numbers are a lot less, right? A lot of that has to do with the fact that, again, you have less corporations, but this is also why I talk so much about the importance of creating these entities. I cannot reiterate enough how important it is to create entities, partnerships, corporations, nonprofits, trusts, you know. It helps because, again, you're in a system. And, you know, I talk to a lot of people who complain, don't like the system. And I'm like, well, opt out. Like, I don't know what to tell you, you know. More and more, I'm under the impression that losers complain and winners win, right? So, you know, when I do run across someone complaining about the tax system or complaining about how we're being taxed, complaining about wealth inequality, for me, it just lets me know, okay, well, you're probably a loser, right? You're probably a loser. And so I understand your complaint, but how about let's figure out how to win, right? And I think that just takes a mentality. That just takes a mentality to say, yeah, I'm being screwed over. Let me figure out how to not be screwed over, you know? And then what's really important here is we get down to partnership returns, S corps, okay, and other non-taxable returns. And we see a big NA here, right? And NA is for recommended additional tax. So remember, these partnerships, S corps, and non-taxable corporations are not taxed. So if they are audited, there's no additional tax that can be added. Sometimes, you know, you're you know, forced to maybe amend a K1 or something like that. That may increase your taxes on your individual return, but it's not going to do anything for that that partnership or that S corp. All right, so let's talk now about the, yeah. So I have to go back to my last video to see if this has changed. Maybe it hasn't, but I think I remember in my last video the 2019 statistics actually showed the percentage of returns audited, and in the 2020 book, they didn't show a percentage of returns audited. They only gave us the numbers, and you can do the math to figure out the percentage, but you know, they obviously did it on purpose. There's just no way that they didn't. You know? No different, and I talked about this in a previous video about the CSET date or set off date. You know, it used to be that you can ask the IRS for a payoff calculator, or you can ask them straight up for the set off date, or the CSET date, which is the date that which the tax liability becomes non-collectible, meaning you don't have to pay it. They changed that a couple years ago, and I had a lot of conversations with IRS employees about it. You know, again, if you don't know, you don't know, and that's the problem. If you don't know, you can easily be taken advantage of, and that's what happens. You don't even know you're being taken advantage of because you didn't know from the start. And so anyway, that's a policy that they changed where you can't ask them for a CSET date. It's crazy. And we're seeing this here. You know, when I look at earnings reports and I look at balance sheets and income statements, you know, as a forensic accountant, you know, I'm skeptical and I really get into the numbers. And and when you see stuff like this, you can't help but say, well, obviously this was on purpose. Obviously, because if I can do the math to figure out the percentage, you can, and you're showing me the percentage for older years, but you're not showing the percentage for the current year. What's up with that, right? So, um, anyway, as you can see, again, of income, 2% of those returns were audited. Okay, and so you can kind of go down the list. $125,000.4. Okay, were audited. That's 0.4%. Okay, 0.2, and then look, as the income gets higher, they actually get audited less and less until you get to the $500,000 million range, and it jumps back up to 1, but it still doesn't get as high as someone who's filing a return with zero income. Okay, and then here at the $10 million range, it jumps way up to 5.3. Okay. The other thing to mention here, and again, they didn't show a percentage. You can easily do the math on this stuff, though. Okay, I'll put all the links in the description if you're interested. But this is the number of returns audited without any change, meaning that basically the IRS audited you and they lost. Okay, they lost. Whether it was a letter correspondent thing where you had to, or whether it was a field examination where you had to actually walk into the IRS office, the number of returns that were audited without any change are teeny tiny in comparison to the returns that have additional tax assessed, even when you look at the total positive income. Okay, again, I'm not going to do the math on that. I don't really think we need to. Okay, we're talking about 133 versus 18,000. What is that? 15,000% or something crazy? I mean, it's ridiculous, you know. The other thing too, and I think I pulled this up. Let me see. Let's see, corporate returns, same thing, right? So the numbers vary quite a bit, but as you can see, as more income is in there, the number tends to go up. And then when you get really big, it gets up to almost 37%. And I will say to you, you know, based on experience, right? When you're dealing with a huge corporation, you're talking about, what is that, $20 billion or more, usually they have an IRS employee assigned to them, right? So an audit and examination with these particular companies, it's more of a common thing. It's not even like an audit. It's just that's just the way business is done. You know, you file your accounting stuff, you file your returns, and there's gonna be someone there already to look at it. And because that person is already there looking at it, I think they count that as an audit. These aren't real audits, the way that I would be audited if the IRS audited me. And so these numbers are a bit out of whack. Even the 5 billion to 20 billion, I'm sure, because I've worked for some Fortune 500s that I'm sure were in that range. Same thing, where they have like an IRS employee designated for them that pretty much looks over everything, and I think those are being counted as audits as well. And again, it may even be the $1 billion to $5 billion range as well. So again, when you're talking about S corp partnership at $1 to 250,000, 0.1. Right? Compare that to someone who's making $25,000 a year. And the question becomes, can someone who makes $25,000 a year have an S Corp? Of course they can. Of course they can. right? And so the idea here is that your S corp will be less likely of being audited than your 1040 individual return is. And so my strategy is always to put as much activity as we can on these other entities. And your 1040 should be very simple. We're talking about income and that's it. Right? Just, you know what I mean? Like maybe a W-2 or a 1099, maybe a Schedule D, capital gains, and that's it. You don't want to have anything else on there. You know what I mean? All of the activity, all of the deductions, everything that you want to do under the rug and under the table and in the air, all that stuff we want to put on these other entities because those other entities are a lot less likely to get audited. Okay. And then, of course, we get down here to partnership returns. And as you can see, there is a footnote there. Okay. S Corps, point one. Okay. Estates and trust. Again, we have a footnote there. All right. And so let's take a look and see if I have that footnote. No, I don't. I'm going to scroll down to it. It's okay. Far. So I thought I did look at it. What is this one? Oh, okay, yeah, now it's the same one. It's 2020. There we go. All right, footnote B. Here we go. I thought this was interesting. Not shown to avoid disclosure of information about specific taxpayers. So every time you saw a D in those columns, basically what they're saying is that the number is so small that if we told you the number, you'll be able to deduce who we're talking about. So they don't disclose those numbers. SBA said the same thing, when asked about who received $10 million or more. I think in PPP loans, they were like, we can't disclose that information because if we do, you'll know who they are. You know what I mean? And eventually a judge made them disclose it. And now we all found who those persons were. And then, of course, number 9, a footnote includes 706 generation skipping transfer tax returns, which are negligible, right? But the reason why they included that, right, is because, again, the number is so small that they don't have a number there, right? So let's go back and look at that because I want to make sure that's understood. So see if I can find one right here. Go in here. I think I'm going to go all the way back up to the 2018. Yeah. All right, here we go. See? So partnership returns, right? Footnote number 9. And so remember, this is a percentage of the number of those returns that were being audited. So what they're saying is, all right, these include generation skipping gift tax returns, right? But there's no number there. And then over here in NA, right, not applicable. And what I think this is just their way of saying the number is so small that if we put a number there, you'll be able to deduce who it is we're talking about. And the way they covered that up is by saying these include generation uh, generation skipping gift tax returns, which would then add to the number to try to increase it, but still doesn't increase it large enough for them to even put a number there. And those are partnership returns. I advise most parents, if you have a child, create a partnership with your child. Because there are lots and lots and lots of tax deductions to be had from those partnerships that roll right over into your personal tax return. I mean, something very, very simple, and I know we've all heard of this, is paying your children, right? Every year they increase the standard deduction for individuals. I think this year is like 12,500 or something. So as a partnership, you can pay the child $12,500, and that loss is written off on your personal tax return. That's a very simple thing to do, and keep in mind the partnership return probably is not going to get audited, right? Um, and so yeah, you're talking about a $12,000 write-off kind of right away without doing much of anything. Um, and it's all legit, especially if you are actually giving your child money. I don't have any children myself, but I do spend a lot of time with children and have a lot of financial transactions with children. I take them out, we go out, we do things, I feed them, they've stayed in my house, right? All those things cost money. All those things can be accounted for and put on a return. And legally, the way it works is if it's done for business purposes. And I always tell people that everything I do is business. And that's not something I just say. That's really how I work. Like, I think of everything like a business, and that's what makes me good at what I do. Um, and so it's very easy for me to look at me feeding a child and say, well, yeah, that's definitely a business expense. No question about it. Because a business is simply an entity or a person that's trying to make money, trying to turn a profit. That's all I want to do is turn a profit. I meet a lot of people that say, well, I'm not a business and I don't want a profit. Well, cool, that's you. Me personally, I want a profit. I'm not in this for nothing. Like, I want to have something at the end of the day when I get done paying everything. So anyway, um, that's that. Um, there was actually something else that I passed by that I know I queued up earlier, and for whatever reason, decided not to discuss, and it's this right here. Um, Total positive income, 100,000 to 1 million. Okay, now it just kind of goes back to the same thing. So this graph just shows that again, audits have decreased over the number of years. It's gotten smaller and smaller. And like I said, I seriously think that is going to continue. Every year they talk about increasing the IRS budget, and it's always a kind of a yay moment for us in the tax industry because we spend so much time dealing with the IRS and are so understaffed and so it's hard for them to do what they need to do. But as an American taxpayer, you can kind of look at it, on one side or the other. You want that. You want a weaker taxing authority so that you pay less tax, but it also means less regulation and so forth. So anyway, that's that 2020 tax book. Looking forward to looking at the 2021 tax book in the coming months.